All right, if you're watching this right now, don't scroll away. Something just snapped in the silver market, and it happened fast. I'm talking about a minus 21.5% move in roughly 24 hours. Silver went from around $120 an ounce to the high 90s, wiping out about $1.4 trillion in paper market value almost overnight. That doesn't happen quietly, and here's the part most people are missing. The real trigger wasn't demand collapsing, it was leverage breaking. Both futures positioning data and physical market pricing just confirmed that disconnect, and that's why this matters right now. Stay with me because I'm going to walk you through what just broke, how to spot this pattern next time, and why moments like this often show up right before major inflection points. If you're holding silver, if you're watching from the sidelines, if you're trying to make sense of what just happened, you're in the right place. Your job is to understand the mechanics, not just react to the headlines. Before I explain what caused this move, let me teach you something most people never really internalize about markets like silver. Price isn't just about buyers and sellers of the metal, it's about leverage layered on top of belief. When price starts going vertical, especially in thin markets, traders don't just buy more silver, they borrow exposure to it. Think of it like stacking kindling higher and higher. It looks impressive on the way up, but it only takes one spark to turn it into a firestorm. Futures markets allow massive exposure with relatively small capital, and when that leverage builds too far, price becomes fragile. You might see headlines screaming collapse, but underneath, nothing about real-world usage changed at all. That distinction is everything. So what does that tell us? It tells us that when you see violent moves in leveraged markets, your first question shouldn't be what broke fundamentally. Your first question should be what leverage just got unwound. Because more often than not, that's the real story. If this is making sense so far, drop a comment below and let me know what you're watching in this move. Now here's what's actually happening. Let me break down the sequence because this is where the lesson is. Silver had been in a parabolic rally. That's not an opinion, that's just math. When price accelerates faster than liquidity can absorb it, margin requirements rise. Exchanges don't have a choice, they have to protect the system. As price surged toward 120, those open interest ballooned. That means more contracts, more leverage, more borrowed exposure. People weren't just buying silver, they were buying the right to control silver with a fraction of the capital it would take to own it outright. And that works beautifully when price keeps climbing. But then liquidity thinned, fewer buyers willing to step in at those levels. Bid-ask spreads widened, and when the first sharp pullback hit, margins were suddenly breached. Traders who were leveraged 10 to 1 or 20 to 1 suddenly didn't have enough collateral to maintain their positions. So when they couldn't post more money, positions were forcibly closed, not voluntarily forced. And when forced selling hits a leveraged futures market, it cascades. One liquidation pushes price lower, which triggers the next margin call, and then the next, and then the next. That's how you get a 20% plus move in a single day. It's not organic selling, it's mechanical unwinding. But here's the part that should make you pause. While paper silver was collapsing, physical prices in China didn't follow. Shanghai premiums stayed elevated. That tells you something critical. If this were a real demand collapse, if industrial users suddenly didn't need silver anymore, if jewelry demand evaporated, physical markets would be flooding with supply. Sellers would be desperate to offload metal, premiums would collapse. Instead, premiums remained tight, in some cases above 20%, signaling stress, not abundance. That divergence is the fingerprint of a paper market deleveraging event. The paper price resets violently because leverage has to clear. Physical markets barely flinch because the actual metal isn't moving in panic. When you see that split, you're not watching fundamentals break. You're watching a technical reset play out in real time. Now let me add another layer here because this matters. Open interest data from the futures exchanges showed a massive spike in the days leading up to this drop. We're talking about positions that represent billions of dollars in notional exposure built on relatively thin margin deposits. And here's what very few people are talking about. When volatility explodes like this, exchanges raise margin requirements mid-cycle. They did it during the run-up, and they did it again as price started falling. That's a double squeeze. You need more money to hold your position when price is rising, and then you need even more money when price starts falling and volatility spikes. If you can't meet those calls, you're out. Your broker liquidates you at whatever price the market will bear. And in a market that's already falling, that price isn't good. This isn't about manipulation in the traditional sense. This is about how leveraged markets function under stress. The mechanics are transparent if you know where to look. This is the exact same playbook we've seen before. Go back to 2008. Silver was crushed during the financial crisis, not because people stopped needing it, but because leveraged positions were unwound indiscriminately. Everything liquid was sold to meet margin calls, hedge funds, banks, retail traders. It didn't matter. If you had exposure and you needed cash, you sold what you could sell. Silver dropped from the mid-teens to under $9 in a matter of months. Look at 2011. After silver's blow-off top near $50, margin hikes triggered a brutal sell-off. The CME raised margin requirements 5 times in 8 days. 5 times? That forced massive liquidation. Silver fell 30% in a week. And then March 2020, when COVID hit and everything seized up, silver dropped from $18 to $12 in days, even though nothing about silver's supply or demand had fundamentally changed. Each time silver didn't end, it reset. Zoom out and you see the larger story. Violent downside moves driven by leverage often clear the path for the next structural advance. The weak hands get flushed, the leverage gets cleared, and then when conditions stabilize, price can build on a firmer foundation. The pattern isn't comfortable, but it's consistent. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be something worse? Sure. Could broader risk-off conditions drag silver lower if we're entering a real deflationary scare? Absolutely. Could global growth slow and industrial demand actually weaken? Yes, that's possible. And let me be honest about manipulation claims too. Yes, futures markets are distorted. Yes, there are players with enormous positions who can influence price in the short term. But you don't need conspiracy theories to explain this move. Forced selling explains it cleanly. The data supports it. Physical premiums support it. Volatility patterns support it. Here's the thing. It doesn't actually matter whether there's some coordinated effort or not. The mechanics are what matter. Focus on what you can verify. Physical premiums, open interest changes, volatility spikes, exchange margin requirement announcements. Those are observable, repeatable signals. If you anchor to data instead of emotion, you stay grounded when markets get loud. There are probably 3 types of people watching this right now. The first is panicked. You're long, you saw red everywhere, maybe you're leveraged yourself, and you're wondering if something is fundamentally broken. Let me say this clearly. Panic is exactly what forced selling feeds on. If you're in this camp, zoom out and assess your exposure, not the price action. Are you over-leveraged? If yes, reduce risk and sleep better. Are you positioned within your tolerance? Then volatility is noise. The fundamentals around silver, the supply constraints, the industrial demand, the monetary role, none of that changed in 24 hours. What changed is leverage got flushed. That's technical, not fundamental. The second group is sidelined. You're thinking, I knew this was a bubble, I stayed out, and look what happened. Maybe. But bubbles don't usually unwind with physical markets holding firm and premiums staying elevated. For you, patience matters more than victory laps. If this was purely speculative froth, we'd see physical liquidation too. We're not seeing that. So maybe be curious instead of certain. The third group is analytical. You're watching levels, you're checking premiums, you're monitoring positioning data. For you, this is about confirmation, not prediction. You want to see if the reset completes or if there's more downside. You're asking the right questions. No matter which camp you're in, the universal principle is the same. Markets move in cycles of leverage expansion and contraction. Learn to spot which phase you're in, and you'll navigate these moves with a lot more clarity. So here's what I want you to answer in the comments. Which camp are you in right now, and what's your biggest question about what just happened? Here's where I stand. I'm not euphoric and I'm not bearish. I'm focused. Let me tell you what I'm personally watching. First, I'm watching the $95 to $100 zone closely, because that's where stabilization usually starts if selling pressure exhausts. If silver can hold that range and volatility starts compressing, that would indicate the forced liquidation phase is completing. Second, I'm watching Shanghai premiums. If they stay above 20%, that's a loud signal that physical tightness hasn't resolved. That would tell me the paper price overshot on the downside and physical demand is still there. Third, I'm monitoring volatility and open interest together. When price stops falling but leverage continues to unwind, when open interest keeps dropping even as price stabilizes, that's often the tell that the worst is behind us. Based on my analysis, this drop was mechanical, not emotional. It was structural, not random. The fundamental picture around silver hasn't disappeared overnight. Supply is still constrained. Industrial demand for solar, electronics, and green technology is still growing. Central banks are still diversifying reserves. None of that changed because futures traders got squeezed. And if history rhymes and silver consolidates above $95 and builds a base, the move that follows could be significant. I'm not making predictions, I'm just telling you what the pattern suggests. Now, I'm not a financial advisor. This is not financial advice. Do your own research, verify everything I've said, check the data yourself, look at the charts, read the exchange announcements, track the premiums. Don't take my word for it or anyone else's. Make your own decisions based on your own analysis and your own risk tolerance. But if you made it this far, you're already thinking critically. You're not just reacting, you're processing. That mentality will serve you well in markets like this, where emotion and leverage create chaos, but patterns and mechanics provide clarity. If you found this breakdown valuable, share it with someone who needs to see it. Subscribe if you want more analysis like this. And stay ahead of the noise by understanding the structure underneath the headlines. Think critically, verify the data yourself, and make your own decisions. Stay sharp out there.